The stock market can feel overwhelming, not because there's nothing to choose from, but because there's too much to choose from. Everywhere you look, there's a new fund, a new strategy, a new best option that promises long-term success. And when everything sounds good on paper, it's hard to tell what actually matters. But over decades of investing, even small differences in how a fund is built can turn into massive differences in results, sometimes over $1 million. So it leads to the question almost every investor asks sooner or later: if you could only pick one index fund, which one actually gives you the best long-term outcome? In this video, I'll break down 5 heavily recommended index funds and show you how each one behaves over years of compounding. I'll compare returns, volatility, dividends, and sector exposure so you can see the real story behind each pick. And right at the end, I'll show you and Josh the best one of all the index funds that can turn $10 a day into over a $2.2 million portfolio while paying over $6,000 in monthly dividend income. So before we break down each index fund on the list, it helps to get clear on why choosing the right one even matters. Because once you understand this part, everything else becomes way easier to compare. Think of index funds like different types of cars. On the surface, they all look like they do the same thing. They get you from point A to point B. But under the hood, some are built for speed, some for comfort, some for fuel efficiency. And if you pick the wrong one for the kind of trip you're taking, you're going to feel it later. Index funds work the same way. They might all track the market, but how they track it is completely different. One fund may own thousands of companies, including a lot of slow movers that drag performance. Another might focus only on the biggest companies, giving you stability but cutting off some high growth. And then you have the funds that lean heavily into tech or innovation. Great when the market runs, brutal when it pulls back. These differences don't seem like a big deal in the short term, but stretch them over 10 or 20 years and the gap in total return can be massive. That's why picking the right fund isn't about chasing the hottest chart. It's about investing in something that keeps growing your money over the long run. Now that the why is clear, here's what actually matters when you compare index funds. Before looking at all 5, we need a simple checklist. Once you know what to look for, the differences between these funds become obvious. The first thing that matters is long-term growth. Not what happened last year, but how consistently a fund grows over 10, 20, or 30 years. Then comes dividend growth. Even small annual increases can snowball into a huge difference when they're reinvested over the years. Next is sector balance. Some funds lean heavily into tech, others spread across areas like healthcare, financials, or consumer companies. Neither approach is automatically better. What matters is whether the mix supports steady long-term growth. Volatility is another piece of the puzzle. If a fund swings too much, most people won't stay invested. If it barely moves, it might not build momentum over time. Costs also play a role. Lower fees simply leave more money in your account to grow. And finally, future alignment. Does the fund hold companies that are likely to grow in the years ahead, not just the ones that performed well in the past? None of these criteria is complicated. They simply help us understand how each fund behaves and what kind of long-term journey it creates. So with that in mind, let's look at the 5 funds that get recommended the most and which one actually holds up as the best long-term choice. First up is Schwab Total Stock Market Index Fund, or SWTSX for short. This is a fund you'll see almost everywhere, and at first glance, it checks a lot of boxes. It tracks the entire US stock market using full replication, which means it isn't sampling or guessing. It actually owns almost every publicly traded stock with solid pricing data. It launched in 1999 under Charles Schwab Investment Management, and because it mirrors the Dow Jones US Total Stock Market Index Fund, you get exposure to large cap, mid cap, and small cap companies all in one place. If you want broad coverage, this fund absolutely gives you that. But when you dig a little deeper, things get interesting. Even though the fund holds 2,988 stocks, a huge chunk of its performance still comes from the top 10 names, which make up 33.98% of the entire fund. Those names are the giants everyone knows: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and a few others. Tech alone accounts for 33.84% of the whole portfolio. So even though SWTSX calls itself a total market fund, it behaves a lot like a tech-tilted large cap fund rather than a perfectly balanced snapshot of the entire market. The returns reflect that tilt. Over the past year, SWTSX returned 11.17%. Over 5 years, it gained 76.55%. Over 10 years, it grew by 199.89%. The compounding is steady and reliable. The costs are extremely low too. Its expense ratio is 0.03%, meaning that's the tiny yearly fee you pay them to run the fund. The turnover rate is just 2%, which tells you they rarely buy or sell stocks inside the fund. And the beta sits around 1.02, which means it moves almost the same way the overall market moves. All of this makes SWTSX predictable and easy for most people to hold. But that predictability also exposes its biggest drawback. When you own the entire market, you also own a lot of slow-moving companies that barely contribute to your growth. The strongest companies at the top are always being balanced out by weaker ones at the bottom. So while SWTSX gives you full coverage, that full coverage can hold back your long-term performance compared to more focused funds. It's a reliable choice if you want something simple that covers almost everything without needing to rebalance. But if the goal is to choose one fund with the highest long-term potential, SWTSX doesn't quite get there. So the natural move is to look toward the S&P 500 because it trims out the weaker players and focuses on the companies that actually drive the market forward. And that's exactly where Schwab S&P 500 Index Fund, or SWPPX, comes in. This is a fund almost every investor comes across at some point. It's straightforward, consistent, and backed by decades of reliable performance. It tracks the S&P 500 using full replication, which simply means it owns every company in the index instead of sampling or guessing. Launched in 1997 under Charles Schwab Investment Management, it follows one of the most trusted market benchmarks with near-perfect accuracy. When people say just buy the S&P 500, this is the type of fund they're talking about. The performance explains why it's so popular. Over the past year, it returned 12.33%. Over 5 years, it's up 85.17%. Over 10 years, the total growth has reached 214.45%. That strength comes from the same big names that showed up in the previous fund: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, and Berkshire Hathaway. But here's the difference that matters. The top 10 take up 38.6% of SWPPX, which is noticeably higher than the weighting in SWTSX. And with tech alone at 35.62%, the fund leans even harder into the companies actually driving most of the market's long-term growth. Its costs are extremely low, too. The expense ratio is 0.02%, which is the tiny yearly fee to hold it. The turnover rate sits around 2%, meaning they rarely buy or sell inside the portfolio. And the beta is 1, which means the fund moves almost exactly the same way the overall market does. For a lot of investors, that level of predictability feels like the ideal balance: simple exposure to the biggest companies without any complicated structures. But this strength also shows you what SWPPX leaves on the table. By focusing only on large-cap companies, it cuts out the slow and weaker small-cap names that held SWTSX back, which is good. But at the same time, it also misses the handful of smaller companies that eventually break out and become the next generation of market leaders. So you get more focus and more stability, but you also give up a slice of long-term upside that comes from catching those early winners before they grow. SWPPX is still an excellent long-term core holding, and for many people, it's everything they need. But if you're aiming for a single fund that pushes growth further without getting too extreme, this isn't the one. Next, I'll show you an index fund that takes a completely different approach from traditional index funds. And in the end, I'll show you and Josh the best one of all the index funds that can turn $10 a day into over a $2.2 million portfolio while paying over $6,000 in monthly dividend income. But before we get there, let's take a look at this unique fund. Schwab Target 2045 Index Fund, or SWYHX, doesn't behave like the other funds on this list. Instead of tracking a traditional stock index, it follows a target date setup built for people planning to retire around 2045. It invests through a group of Schwab ETFs, and it uses a glide path that slowly shifts the mix from aggressive to conservative as the target date gets closer. In simple words, it's designed to grow while you're younger and protect your money as you age, without you ever having to adjust anything yourself. On paper, that sounds convenient. Over the past year, SWYHX returned 11.34%. Over 5 years, it gained 45.78%. And since its inception, it has grown 113.47%. The fund holds only 9 underlying ETFs, which together account for 99.33% of the entire portfolio. These ETFs are spread across US stocks, international stocks, and fixed income assets depending on where the glide path sits. That design gives the fund an automatic diversification that slowly rebalances itself over time. This also makes it one of the most valuable funds if you're looking for solid monthly passive income by the time you retire. But this same structure is what limits it if you're trying to pick one long-term growth fund. Because SWYX must follow its preset glide path, it can't lean into fast-growing sectors when they're leading the market. It also can't avoid weaker areas when they're lagging. No matter what's happening in tech, healthcare, or bonds, the fund sticks to the schedule. The turnover rate is 14%, which is higher than most stock-focused index funds, but that's mostly from the constant rebalancing required by the glide path. And the built-in bond exposure, while smart for retirement planning, naturally slows during long-term growth compared to funds that stay fully invested in stocks. The international exposure adds another layer of volatility without consistently boosting returns. All of this works well for someone following a full retirement plan, but it doesn't fit someone searching for one fund with maximum long-term upside. It's steady, predictable, and hands-off, but not built for peak growth. Now, if you do want something built specifically for long-term growth, even if it comes with a bit more volatility, the next fund takes things in a much more aggressive direction. And that's the Fidelity Nasdaq Composite Index Fund, or FNCMX for short. This index fund is a pure growth play. It tracks the Nasdaq Composite Index, which is filled with technology companies, innovative businesses, and fast-moving market leaders. Instead of spreading across every corner of the US market, FNCMX focuses on the parts where new ideas scale quickly. It launched in 2003 under Fidelity and uses a representative sampling approach, meaning it doesn't hold every stock in the index, but it still acts almost exactly like the index. The performance numbers show why it stands out. Over the past year, it returned 20.87%. Over the past 5 years, it has increased by 91.7%. Over 10 years, the total growth has reached 319.53%. These gains come from its biggest holdings: Nvidia, Microsoft, Apple, Amazon, Meta, Alphabet, Tesla, Broadcom, and Netflix. Basically the companies driving modern technology. The top 10 make up 59.65% of the entire fund, and tech alone accounts for 52.24%. With so much of the fund concentrated in fast-growing names, FNCMX reacts quickly to market trends. That concentration is both the fund's strength and its challenge. It can outperform almost anything else during strong markets, but it's far more volatile than broader funds like SWTSX or SWPPX. The expense ratio is 0.29%, higher than the other funds we've looked at, and while the turnover rate is a calm 2%, the swings come from the fund's tech-heavy nature, not from trading activity. Dividend income is very small here. FNCMX does almost all of its compounding through price growth rather than cash payouts, which means it can grow aggressively, but doesn't offer the same balance you get from funds with stronger dividend growth. FNCMX is the definition of high reward and high volatility. It fits someone who's comfortable with big ups and downs and wants as much long-term upside as possible. But if you're looking for one fund that blends growth, stability, and smoother compounding, FNCMX leans a bit too far toward the aggressive side. And that brings us to the next section: what the perfect this year index fund actually needs to deliver if you want both strong growth and reliability over the long run. A great long-term fund has to grow steadily across full market cycles, not just in the good years. It should lean into sectors that actually shape the future: technology, healthcare, communication, but without becoming so concentrated that every swing in the market feels like a roller coaster. It needs to compound consistently, stay reasonably stable while still paying good passive income, and keep costs low so more of your money keeps working for you. Most importantly, it should hold companies that look prepared to grow in the decade ahead, not just the ones that happen to perform well in the last decade. When you combine those traits, you end up with a fund built for real long-term success, and that's exactly where the final pick comes in. Fidelity US Sustainability Index Fund, or FITLX for short. This fund checks every box the other funds miss, and once you see how it's built, it becomes clear why it stands out as the strongest single fund choice for this year. It tracks a US sustainability screened index, which simply means it focuses on financially strong, well-run companies with durable long-term fundamentals. Launched in 2016 under the Fidelity Concord Street Trust and managed by Fidelity with Geode Capital Management, it uses a representative sampling approach to stay efficient while still matching its benchmark closely. Think of it as a broad market fund that filters out the dead weight. Performance is where FITLX begins to separate itself. Over the past year, it returned 11.65%. Over 5 years, it gained 89.81%. Since its inception, it's up 202.61%. Those numbers show steady growth without the extreme swings you see in more aggressive funds like FNCMX.
Its top 10 holdings make up 49.79% of the fund, which sounds heavy at first, but the weight is concentrated in companies that have proven they can grow for decades and still have room to run. Nvidia, Microsoft, Alphabet, Tesla, Eli Lilly, Visa, MasterCard. The difference here is that FITLX isn't top-heavy by accident. It doesn't hold thousands of stocks. It intentionally filters out weaker and unstable companies so the money naturally leans toward high-quality leaders with strong balance sheets and predictable long-term demand. And because the fund spreads the rest of its portfolio across financials, communication, consumer cyclical, and healthcare, it avoids the extreme ups and downs you see in tech-only funds. You end up with focused growth, but without the chaos that comes from putting everything into one sector. Compared to FNCMX, which has more than half its portfolio in tech, and SWTSX, which gets pulled down by thousands of slow-moving names, FITLX lands in the middle, growth-focused but stable. Costs help too. The expense ratio sits at just 0.11%, and the turnover rate is 9%, which keeps the fund efficient while avoiding unnecessary trading. It isn't stretched across too many companies, and it isn't bogged down by low performers, which helps compounding work. But the biggest reason FITLX is the best fit is its future alignment. Its sustainability screen isn't about green investing. It removes financially weak, high-risk, or poorly managed companies that drag long-term performance down. What you're left with is a portfolio built around durable, resilient businesses that are positioned to grow over the next decade, not just the last one. When you combine its growth potential, sector balance, efficiency, stability, and forward-looking design, FITLX becomes the one fund that gives long-term investors the strongest probability of success going into this year. Looking at index funds year by year doesn't show you much. The real impact of compounding only shows up when you stretch things out over 10, 20, and 30 years from now, and that's why this $10 a day projection matters so much. Here's what happens when you invest $10 into FITLX. After 1 year, you would have invested around $3,650. This sets the stage for future growth. By year 10, the balance will be projected at roughly $76,000 with annual dividends approaching $1,000. By year 20, that same $10 a day is projected to reach around $424,000 and yearly dividends will climb toward $9,000. The final decade brings most of the growth. By year 30, the portfolio is projected at roughly $2.2 million and annual dividend income will push towards $75,000, which is over $6,000 a month in passive income. Now, when you look at all 5 index funds side by side over a full 30-year stretch, the differences become impossible to ignore. With the same $10 a day contribution, their projected long-term paths will move in completely different directions. SWTSX will grow the slowest, ending around $894,000. SWPPX will sit slightly higher at roughly $1 million. SWYHX will climb to about $1.47 million by year 30. Then the gap will widen. FNCMX will reach close to $1.98 million, and FITLX will top the list at roughly $2.2 million. None of these funds failed, they all grew, but the spread between the lowest performer and the highest performer is more than $1 million, created solely by different growth rates compounding over decades. On the other hand, dividends also tell an even more dramatic story. SWTSX, SWPPX, and FNCMX all land in a similar zone, finishing with roughly $700 to $1,000 in yearly dividend income by year 30. Those payouts are small because those funds lean heavily toward broad market or growth-centric structures that don't prioritize dividend expansion. FITLX does break away from that pattern. Its yearly dividends are projected to climb to around $75,000, supported by stronger compounding and a more balanced mix of growth-aligned sectors. But the biggest outlier is SWYHX, which is projected to reach about $130,500 in yearly dividends by year 30. Its structure keeps pulling more weight from dividends as the years go on, creating faster income growth the longer you hold it. Though SWYHX will deliver higher dividend income, FITLX will still end up with the stronger overall result. By year 30, SWYHX is projected to reach about $1.47 million, while FITLX is projected at $2.2 million. That's a gap of more than $700,000 in total value. And that's the key point. SWYHX will produce more dividend income, but FITLX will deliver both meaningful dividend growth and the highest long-term portfolio value. That mix, solid income and the strongest overall growth, is what makes FITLX the one fund that balances everything best over the long run. Want to know how to earn over $8,000 in monthly dividend income using 5 compounding strategies? Click the video on screen to find out.